Ainsley News. It's Wednesday, the 16th of September. Interesting times on the market within the last few days. Today we're talking math, risk and return of capital. After this recent Wall Street correction, the futures market are telling us the herd are now bullish again, with short interest on the NYSE falling sharply. As real investment advice Lance Roberts tweeted, as we show next, that leaves little room for tolerance of any unexpected further falls. Check out this next tweet from him. Such a setup implies the market sees the correction as returning shares to fair, buyable value, despite valuations remaining sky high and a host of risks still at play. Roberts agrees there is real potential for another rally from here, but adds that the risks are very real to the downside. Quote, lots of risks to the bullish outlook. While we used to sell off to add some holdings to our portfolios, we remain cautious for several reasons. Point 1, the market is fully priced to whatever economic recovery we are likely to see near term. Point 2, there is clear evidence of weakening economic data and slower earnings growth. 3, investors are counting on a vaccine to restore the economy to its previous strength fully. Point 4, the markets have entirely discounted the potential for an election event. 5, market participants have discounted the additional stimulus to sustain economic growth and recovery. Point 6, the Fed is on the sidelines for now. Without additional treasury issuance, the Fed has far less ability to provide additional liquidity to the market. 7, while the economy is indeed recovering, along with employment, it will still likely fall well short of pre-pandemic levels, stifling future earnings growth and revenues. And point 8, investors are paying exceedingly high valuations based on a full earnings recovery, which is unlikely to be the case. They argue that these or those sky-high valuation imply sky-high future earnings. The problem is that it is highly unlikely. The problem is the ability for stocks to continue to grow earnings at a rate to support such high valuations is problematic, such as due to rising debts and deficits, which will retard economic growth in the future. And to wit, before the financial crisis, the economy had a linear growth trend of real GDP of 3.2%. Following the 2008 recession, the growth rate dropped to the exponential growth trend of roughly 2.2%. Instead of reducing the debt problems, unproductive debt and leverage actually increased. The COVID-19 crisis led to a debt surge of new highs. Such will result in the retardation of economic growth to 1.5% or less. Check out this next growth graph here, real GDP versus linear and exponential trends, and what we are expecting to see in the future from real investment advice here. Up to around 2027, they've thrown that prediction in there. In typical pragmatic fashion, Roberts reminds us of some basic math and risk assessment. Overall, our assessment remains one of caution. In the short term, we could well see an oversold bounce that could even recover back to the previous highs. However, we suspect that given the rather numerous headwinds currently facing the markets, from the Fed to the election, that a failure at lower highs would not be surprising. While we did add some exposure near the lows, we will be using the rally to sell into and increase our portfolio hedges heading into the election. If you disagree, that's okay. However, these are the questions we ask ourselves every time we add exposure to portfolios. Point 1, what is the expected return from current valuation levels in percentage terms? Point 2, if I'm wrong, given my current risk exposure, what is my potential downside in percentage terms? And point 3, if point 2 is greater than point 1, then what actions should I be taking now? So point 2 minus point 1 equals a percentage. How you answer those questions is entirely up to you, and what you do with the answers is also up to you. Ignoring the results and hoping that this time will be different has never been a profitable portfolio strategy. We remind you from numerous articles that present historical precedent in the sort of falls one could expect from such a sell-off where 40 to 80% of a drop is the norm. Probably a good time to consider gold and silver. So that's news for today. Remember, you can jump into ainsleyBullion.com.au for all things gold and silver, and even platinum if you're interested in platinum. ainsleywealth.com.au for all things cryptocurrency. You can also purchase our gold and silver backed token from Ainsley Wealth. That's the platform you should use there. But if you want to research and find out more about our gold and silver backed token, jump over to goldsilverstandard.com. That's a gold and silver backed token, securely held and stored at Reserve Vault for free. You can also redeem that for real gold and silver. There are some terms involved with that one, but do your research and find out more at that website. We'll catch you tomorrow for more news.